when you're looking at bonds, and particularly for US government bonds, typically on a normalized yield curve, you see shorter term treasuries lower and longer term treasuries like 10-year, 30-year at a higher interest rate. When things go a little wacky, then you can see what's called an inverted yield curve. The relationship inverses there, and you have the short-term rate higher than the long-term rate. So looking at that spread there is something that I'd probably look at. Historically, it had been a pretty good indicator when that goes negative and then reverses and it goes positive again, as a pretty good indicator for impending recession. This time around, it has not worked out that way, but I think it's still a good kind of sniff test. The bond market's basically saying something's funky going on in the economy right now. And so currently we're standing at 0.02 for the spread.
Yeah, because it doesn't make sense logically, right? Like logically, let's say you were going to buy a CD, you would expect that if you tied your money up for a longer term, let's say for 5 years, that you would get a higher rate than if you buy like a 6-month CD. But the inverse is happening where you're actually getting higher interest rates on, a 6-month CD than you would on a 5-year, which is just backwards, right? So to your point, that means there's something strange going on.